You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the deep dive. We've got this global markets and geopolitics, October 17 outlook, source material here. Pretty dense stuff.
It really is. Covers a lot of ground currencies.
Yes.
Trade policy, diplomacy.
Right. So our mission today, yours and mine, is basically to cut through all that complexity, give you, the listener, a shortcut to understanding the big global forces shaping things. You know, money, tariffs, conflict.
Yeah.
How it all connects.
Exactly. It's about connecting those dots because, a tariff decision made over here, it doesn't just stay there. It ripples out, affects the yen, changes the mood in diplomatic talks.
Yeah.
So, the goal is to synthesize it, give you one coherent picture of what's really driving risk and maybe opportunity right now.
And honestly, if you had to boil it all down, the dominant story, the big engine underneath everything, it feels like these ongoing trade and tariff tensions, this sort of economic conflict idea.
That's absolutely the core theme. It's not just a blip anymore. It's like a permanent feature of the landscape now. And you see its fingerprints straight away in the FX markets.
Yeah. Okay, good place to start then. Foreign exchange. The dollar's been, steadier this past bit after a really wild week. Maybe a sign things are calming down.
A little deceptive, maybe, because underneath that calm, you've got some pretty big divergences happening.
Like the euro, it's back above 1.16, which feels counterintuitive. Shouldn't Europe be feeling the heat from the trade stuff? Is that strength solid?
That's a fair question. It does seem a bit odd on the surface, but there's been a definite shift in tone. The ECB, the European Central Bank, they've actually sounded pretty constructive lately.
Oh, okay.
And we're seeing some better industrial numbers coming out of the Eurozone, too. So maybe they're projecting this idea that, hey, we can actually handle these global headwinds better than people thought. That confidence seems to be pulling money back into the euro.
Interesting. Okay, meanwhile, across the channel, sterling seems to be doing its own thing. The pound held onto its gains after UK growth figures came in pretty much as expected.
Yeah, in-line growth. And importantly, we're finally starting to see some signals that the labor market over there, which has been super tight, might actually be loosening up a bit. Yeah. That's something the Bank of England has really been watching for.
Right.
But what's really striking about sterling right now is how much it seems driven by purely domestic factors, almost like it's in its own little bubble, ignoring the global trade drama for a minute.
How so?
It's reacting much more to the internal political debate. Specifically, the run-up to the November budget. There's more and more talk about potentially higher taxes on wealthier households. So it's navigating local politics while everyone else is obsessed with tariffs.
Gotcha. So sterling's focus inward.
Yeah.
But looking east, the Japanese yen is definitely reacting to the global picture. It firmed up quite a bit.
Risk aversion, right?
Clear risk aversion, yeah. And it's reacting to something very specific out of the Bank of Japan, the BOJ.
What was that? We had a board member come out with some pretty hawkish comments, basically arguing that interest rates there should be moving back towards neutral. That really put the pressure on, especially on the dollar-yen pair, USD/JPY. It was really testing that 150 level.
And just quickly, for listeners maybe not glued to FX screens, why is 150 such a big deal for dollar-yen?
Well, 150 isn't just a number. It's sort of a psychological line in the sand. It's where traders really start to get nervous about Japan's Ministry of Finance stepping in directly to buy yen.
Intervention risk.
Exactly. Japan doesn't like seeing the yen weaken too quickly, so any moves around 150 feel very high stakes. The market did bounce off it a little, but that threat, that possibility of intervention, it's always there in the background now.
Okay. And rounding out the majors, if we look at the Aussie and Kiwi dollars, back to the trade theme.
Definitely. Direct link. The Australian dollar, the AUD, it's still looking pretty heavy. They had a weaker jobs report. Unemployment ticked up.
Right.
And the New Zealand dollar, the NZD, is maybe a tiny bit steadier, but not by much.
And the connection is China.
Absolutely. You could call them the China canaries. Both the Aussie and the Kiwi are incredibly sensitive to any news out of China, any shift in the daily yuan fixing, a whiff of bad trade news, and money flows out of those currencies almost instantly. They're seen as proxies for China's economic health. It really shows how interconnected it all is.
Yeah, no kidding. Okay, let's shift gears. Commodities.
Yeah.
Because, this is where it gets really telling, I think, when you see this kind of split, gold doing one thing, oil doing another.
It absolutely tells a story of mixed anxieties, maybe. The market seems worried about the long-term structural stuff, like trade uncertainty.
Right, the big picture.
But maybe not yet worried about immediate physical shortages right this second. Look at gold. It surged, hit a new all-time high, briefly touched, mid-$4,300 an ounce?
Wow, before pulling back.
Before pulling back a bit, yeah. But that record move, driven by three main things, really. One, the softer dollar we talked about. Two, that general lingering uncertainty about growth, the trade war effect again. And three, expectations, or maybe hopes, of more easing coming from the U.S. Fed down the line. Gold loves that combination. Uncertainty and the prospect of cheap money.
Okay, so gold's reacting to the macro unease, but crude oil seems completely torn, pulled in different directions.
Totally conflicted. On one side, the bearish side, you had U.S. crude inventories build up more than expected. Usually that signals, demand might be a bit soft.
Okay, makes sense.
But pushing the other way, on the supply side, there are these reports that India has significantly cut back its purchases of Russian crude, apparently after some recent U.S.-India discussions.
Geopolitical angle.
Right. And that could actually tighten up regional oil flows, mess with shipping balances, even if the overall global demand picture is still a bit murky. So oil just can't make up its mind whether to go up or down. It's stuck.
And copper, the sort of Dr. Copper indicator for the global economy.
Copper slipped. Pretty much in line with that broader risk-off feeling. People think of copper as the wiring and plumbing of the world economy.
Yeah.
When companies hesitate about building new factories, new cars, new infrastructure, copper's often the first metal to show signs of that economic slowdown. Trade uncertainty is like poison for base metal demand. Simple as that.
Which, brings us right back to that dominant macro driver we started with, this whole trade and tariff situation. It's not just policy anymore, is it? The White House is explicitly framing it as national security, saying things like, the U.S. is in a trade war with China, and tariffs are a national security tool. That language really changes the game.
It really does. And crucially, that framing keeps the door open for even more measures, things that aren't purely economic. Now, China's response is, well, it's complex. They seem to be trying to manage the escalation, but also defend their actions.
How so?
Well, for instance, they're defending these new port fees they slapped on U.S. vessels. But then on something really sensitive like rare earths, they're making a point to say their new controls are not an outright export ban.
Okay. Trying to calm nerves.
Exactly. They're emphasizing that applications for civilian uses will still get approved. It looks like a careful balancing act pushback, but try to avoid causing total panic in global supply chains.
It's fascinatingly complex, though. One minute it's trade war, the next you're hearing about very specific granular negotiations and exceptions, like Washington apparently signaling it might be close to giving some tariff relief for auto parts.
Yeah, and that detail tells you a lot about the power of lobbying, doesn't it? It shows this isn't just some top-down policy decreed from on high. It's actually quite responsive to pressure from powerful domestic industries like the car manufacturers.
Makes sense. So you've got these big picture tensions, but also these specific carve-outs being negotiated. What else? South Korea?
Yeah, South Korea is negotiating the terms for a big investment pledge they've made and also how tariffs will apply to them. The outlook was described as uncertain, but maybe seeing some room for compromise.
Okay. And Mexico, too.
Mexico's in talks about adjusting tariffs on heavy truck parts. And interestingly, the U.S. looked into a big complaint about appliance tariff evasion.
Right, I remember that.
And apparently found no broad evidence of it. So it's this constant back and forth, industry by industry, country by country, under the shadow of the bigger conflict.
So if trade policy and national security are now basically fused together, that leads us directly into the pure geopolitical hotspots where diplomacy seems to be speeding up quite dramatically. Let's pivot there. Middle East first.
Okay. The situation in Gaza, well, the ceasefire is still described as very fragile. We know Israel's military has been told to get contingency plans ready in case fighting flares up again.
Not good.
And adding to the tension, Hamas has said that recovering and transferring the bodies of the remaining hostages is going to take time. Apparently because the tunnel sites are in such bad shape, that delay itself creates pressure.
Sounds incredibly tense, yeah.
Mm-hmm.
Is there anything positive happening on the planning side, maybe for the longer term?
Actually, yes, a little bit. U.S. officials are apparently talking about gradual improvements in getting aid flowing. And, significantly, some early work seems to be starting on a potential stabilization framework, working with partners in the region.
So thinking about the day after.
Exactly. So while the immediate risk feels high, that longer-term planning has begun, which is something.
Okay. And then shifting focus, the Russia-Ukraine situation, diplomacy seems to have really kicked into a higher gear there.
Dramatically so. We had that call between President Trump and President Putin, described as productive.
Right.
And that seems to have directly led to plans for high-level staff meetings next week. They're even talking about a potential summit between the leaders down the road.
That's a big shift.
It's a huge acceleration. But here's the critical tension, the rub. While all this top-level diplomacy is speeding up, Kyiv, Ukraine, has been very clear that it wants to keep its military options open, keep the offensive pressure on.
So they're not just waiting for the diplomats to sort it out.
Not at all. And that creates this really unstable dynamic, doesn't it? You've got the political track moving fast, but the military reality and Ukraine's stated intentions are still very much active.
Yeah, that's a tricky divergence. And the financial world is watching this tension closely, you'd imagine. Circling back to the central banks, the Bank of Japan, you mentioned them earlier.
Right, the BOJ. Observing all this friction, all this uncertainty, especially around trade, they actually caution that it poses a real risk to business sentiment. They see it impacting confidence.
Okay, so let's use that to bring it all together with the central bank policy notes, because, like you said, this links right back to the currency moves and the commodity action we started with.
Exactly. It provides the policy context.
So we had the Fed's Beige Book survey come out, and it basically painted a picture of the U.S. economy as, what, little changed?
Little changed, yeah, with muted labor demand. So it suggests things are maybe cooling off just enough to keep the Fed from doing anything drastic right now.
Okay. But the sources highlighted a really interesting detail. Fed officials apparently disagreed internally about how these ongoing tariffs would affect inflation in the near term. Why is that disagreement important?
It's really important because it shows they're grappling internally with the true costs, the true impact of the trade war. Tariffs, on one hand, push costs up for imported goods, right? That's inflationary.
Push, yeah.
But on the other hand, all this uncertainty created by the trade war tends to dampen demand, makes businesses and consumers hesitant, and that usually pushes inflation down.
So they're fighting different effects.
Exactly. And the split shows the Fed itself isn't sure which force is winning out right now. And that obviously makes setting interest rate policy much, much harder for them.
Okay, so uncertainty even within the Fed. Contrast that with the ECB in Europe. You said they see growth and inflation risks now as more balanced.
More balanced, yes. Which supports the euro strength we talked about. It suggests that maybe, just maybe, Europe is relatively closer to getting its inflation problem under control compared to the U.S.
And that relative clarity is attracting investment.
Seems like it. That relative certainty helps. Yeah. Meanwhile, back in Japan, those hawkish voices we heard from the BOJ, they're part of this broader push. They want to normalize rates, get them off zero. But they keep stressing any move towards neutral has to be really gradual, really dependent on the data. They know they have to tread incredibly carefully.
Walking a tightrope.
Absolutely. Trying to raise rates enough to maybe help the yen a bit, help the domestic economy, but not so fast that they cause panic globally or tip Japan itself into recession, especially with those trade headwinds they themselves identified.
Okay. So we've really covered the map here. We've got a dollar that's stable, but maybe masking these underlying divergences. Gold's hitting records because of deep structural uncertainty. And these trade tensions, they are clearly the main engine driving everything from policy decisions to market moves. So putting it all together, what does this mean for you, the listener, looking ahead?
I think the key things to watch aren't just the daily headlines, but the sort of next structural steps. For the U.S.-China trade path, is the next move towards more negotiation, maybe more carve-outs like the auto parts, or is it towards further escalation? That direction will really dictate commodity prices and risk sentiment.
Okay, U.S.-China track one.
And second, keep a close eye on how those diplomatic tracks evolve in the Middle East, and particularly Ukraine. Those two situations will define the immediate geopolitical risk temperature.
That sums it up perfectly. And maybe a final thought. Building specifically on that Ukraine context, you've got this rapid acceleration in top-level diplomacy, right? Summits being discussed. But at the same time, Kyiv is making it crystal clear they intend to keep fighting, keep their military options on the table.
Yeah, that divergence is key.
So Doesn't that raise the defining question for the next few months? How long can those high-level talks keep going before the reality on the ground forces some kind of concrete demand, a military concession, a withdrawal? Which side blinks first?
That tension right there between the push for diplomacy and the determination to maintain military leverage, that instability is probably the biggest geopolitical risk factor we need to monitor going forward.
That's the core tension to watch.
Absolutely.
All right, until next time, keep digging deeper.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.